Hi everyone. Now let us get into the fifth unit of the chapter, Developments in Financial Reporting, which is named as Human Resource Reporting. What is Human Resource Reporting? It is an attempt to identify, quantify, and report investments made in human resources, which are employees of an organization. Is it mandatory to report human resource accounting? Neither Companies Act 1956 nor Companies Act 2013 have mandated on the usage of human resource reporting. Institute of Chartered Accountants in India have also failed to bring out a definitive standard on this stand. Also, human resource reporting is not enforced in any other world economies. Then what is the point of studying this report? This chapter enables us to study the prominence of accounting, human resource investments, and various theories suggested for the same over the years. Why to report the investment in human resources as assets? Narayan Murthy, ex-chairman of Infosys Limited, said once, "Human resources are the greatest assets of any company. You can raise tariffs or prevent MNCs from entering the country, but you cannot stop employees from leaving if they are unsatisfied." As we all know, any organization cannot survive if it does not have the human assets. Especially in today's IT era, its employees are the most important assets of the organization. In the financial accounting, we record every assets of the organization in monetary term at historical cost. When we consider our employees as our greatest assets, the question arises, can we account for these assets? At what value? How will this value be calculated? Are there any standard for recording the value of human resources? Conventionally, human resources are treated just as any other services purchased from outside the business unit. As a result, conventional balance sheets fail to reflect the value of human assets and hence distort the value of business. Expenses relating to the human resources are charged to current revenue instead of being treated as investments to be amortized over the economic life of employees, with the result that magnitude of net income is significantly distorted. What are the different theories or models suggested till now for reporting human resource assets? There are two headings under which all the theories spoken till now are classified. First one is cost-based models and second one is economic value models. Cost-based models are those theories which values the human resources based on the cost incurred for the same. Example, training cost, recruitment cost, rent allowance, etc. There are two models within cost-based model, which are capitalization of historic cost and replacement cost. Capitalization of historical cost was developed by Mr. R. Likert and his associates at R.G. Barry Corporation in Ohio, USA in the year 1967. The method involves capitalizing of all cost related with making an employee ready for providing service, recruitment, training, development, etc. The sum of such cost for all employees of the enterprise is taken to represent the total value of human resources. The value is amortized annually over the expected length of service of individual employees. The unamortized cost is shown as investment in human assets. If an employee leaves the firm before the expected service life period, the net asset value to that extent is charged to revenue. Replacement cost model or Flamholtz model was developed in the year 1973. This model says human resources are to be valued at the cost borne by the company to replace its human resource by an identical one. Replacement costs are of two types: individual replacement cost and positional replacement cost. Individual replacement costs are those costs incurred to replace an individual by a substitute who can provide the same set of services as that of the individual being replaced. Positional replacement cost refers to the cost of replacing the set of services required from a worker in a defined position. The next model of HRA is economic value model, which calculates the employee's value based on the income they generate. This includes four types of human resource calculations, which are 1. Opportunity cost, 2. Lev and Schwartz model, 3. Stochastic process with service rewards, 4. Valuation on group basis. Opportunity cost model, otherwise termed as the Hakimian and Jones model, was developed in 1967. This model states that value of HR is the maximum earnings received if human resources are put to next best alternative use, or otherwise the opportunity cost. Second model is the Lev and Schwartz model, or discounted wages and salaries model, which was developed in 1971 and is now currently used as the most prominent method for HR valuations. According to this model, value of human capital is the present value of employees' remaining future earnings from employment. This is given by the formula Vy is equal to It divided by 1 plus R raised to T minus Y, where Vy is equal to human capital value of a person of Y years old. It is equal to person's annual earnings up to retirement. R is equal to a discount rate specific to the person, and T is equal to retirement age. Employees have been decomposed by age groups and degrees of skill. Average annual earnings for each age and skill group will then be ascertained. Finally, the present value of future earnings for each group of employees have been calculated on the basis of a capitalization rate. The sum of all such present value of future earnings will be taken as the firm's value of human capital. Economic model generally uses income generated for the firm as the basis of HR valuation, but Lev and Schwartz uses the cost of the company as the basis because they felt that income generated by the workforce is very difficult to measure, since it is the result of group effort of all factors of production. Some of the major criticisms for this model are: 1. Actually, value of an employee is not determined by the cost company pays, but also by the skill and organization role. 2. The model ignores the possibility and probability that the individual may leave organization for reasons other than death or retirement. 3. It ignores the possibility that people may make role changes during their careers. In spite of all these criticisms, Lev and Schwartz is still the most popular method of valuing human resources. The next model in economic models of valuing HR is known as stochastic process with service rewards. As per this method, the present cumulative value of all the possible services that may be rendered by an employee during his or her association with the organization is the value of that individual. This is calculated using the formula E of S is equal to sigma I 1 to n Si into P of Si, where Si represents the quantity of services expected to be rendered by employee in each of his role, and P of Si is the probability that they will be obtained. Si can be derived monetarily in one of the two ways below. A. By determining product of their quantity and price, and B. By calculating the income expected to be derived from their use. The main drawback of this model, however, is the extent of information required to make the necessary estimates of the values of service states, the expected tenure, and the probability that the individual will occupy the state for the specified period of time. However, if this information can be made available, this model emerges as one of the most sophisticated models for determining the value of individuals. The fourth model in economic valuation of human resources is the Juggy and Love model, which is otherwise known as the valuation on group basis. According to this model, value of human resources can be easily found on a group of employees than mere individuals. This involves the following steps. 1. Ascertain the number of employees in each rank. 2. estimate the probability that an employee will be in his rank within the organization or terminated or promoted in the next period. This probability will be estimated for a specified time period. 3. Ascertain the economic value of an employee in a specified rank during each time period. 4. Multiply the above three factors and apply appropriate discount rate to obtain the present value of existing employees in each rank. Merit of this model is that it simplified the calculations and reduced the chances of errors. The only demerit of Juggernaut is that it ignores the individual skills of employees. Is human resource accounting prevalent in India? As we have seen before, neither the Companies Act nor accounting standards have mandated the use of human resource reporting in India. However, this reporting had been introduced in India in the year 1973 to 74 by the public sector company named Bharat Heavy Electricals Limited, and was later followed by more than 20 companies in India, including private enterprises like Infosys. Now, what are the drawbacks of human resource accounting? 1. Not so easy to compute. Human life itself is uncertain, and hence valuing the asset under such foggy conditions is not proper. Like physical assets, human assets cannot be owned, retained and utilized at the sweet will and pleasure of an organization. Hence, treating them as asset in the strict sense of the term would not be appropriate. The so-called asset, after getting enriched within a company, may simply disappear, causing irreparable loss to the company. 2. Results in dehumanizing human resources. For example, a person having a lower value may feel discouraged, and this in itself may affect his competence in work. Let us do some problems to get 100% hold of this chapter. Question number 1. From the following information in respect of EXE Limited, calculate the total value of human capital by following Lev and Schwartz model. 3 age groups of workers classified as unskilled, semi-skilled and skilled workers are given in a table. The question says to apply 15% as the discount factor. We have seen that in Lev and Schwartz model, employees are decomposed by age groups and degrees of skills so as to calculate the human resources. Average annual earnings for each age and skill group will then be ascertained. Finally, the present values of future earnings for each group of employees have been calculated on the basis of a capitalization rate. The sum of such present values of future earnings will be taken as the firm's value of human capital. Let us choose the first group as the unskilled workers of the age group 30 to 39. We assume that all 70 employees are just 30 years old. We now have to find the present value of all earnings received by a single employee in the age of 30 years during the next 10 years, that is 30 to 39. Present value factor for the first year is obtained as 1 by 1.15, which is 0.8696, and for the second year is 1 divided by 1.15 raised to the power of 2 is 0.7561. 3000 received for each year 30, 31, 32 up to 39 is multiplied respectively with 0.8696, 0.7561 up to 0.2472, and the respective sum of all present values can be added up to obtain the total present value of an unskilled employee in the age group of 30 to 39. This can be alternatively found by adding the sum of all present value factors of 15% from 1 to 10 years, that is 0.8696 plus 0.7561 plus up to 0.2472, and multiplying the same with 3000 once and for all. Hence, the sum of all present value factors of 15% for 1 to 10 years is 5.018. Multiplying this with 3000 gives the amount 15,056. This is the present value of all earnings of an unskilled worker who started earning from the age of 30 years and will be reaching the age 39 in 10 years down the line. From the age 40 till 49, it is assumed that the same unskilled worker earns rupees 4,000 per annum, and hence the sum of all present value factors of 15% from the year 11 to 20 is multiplied with 4,000 to arrive at the present value 4,960. From the age 50 till 54, it is assumed that the same unskilled worker earns rupees 5,000 per annum, and hence the sum of all present value factors of 15% from the year 21 to 24 is multiplied with 5,000 to arrive at the present value 1,025. Sum of all present value of all three stages of an unskilled worker turns out to be rupees 21,042. This will be then be multiplied with the total number of unskilled workers in the age of 30 to 39, which is 70. This is done in a calculation at the end. In the same way, present value of all other groups of workers are found. The other groups are unskilled workers of age 40 to 49 and 50 to 54, semi-skilled workers of age 30 to 39, 40 to 49 and 50 to 54, and the skilled workers of the age group 30 to 39, 40 to 49 and 50 to 54. Present value of all groups are computed for their respective number of employees and are beautifully consolidated in a table. Let us now do another type of problem. This question has often been asked in the examinations for 8 marks. From the following details, compute the total value of human resources of skilled and unskilled group of employees according to Lev and Schwartz model. Annual average earning of an employee till retirement age: skilled 75,000 and unskilled 50,000. Age of retirement: skilled 68 and unskilled 65. Discount rate 15% for both. There are 40 employees in the skilled group and 50 employees in the unskilled group. Average age for the skilled group is 65 and that of unskilled group is 63. Let us now see how to answer this question. Total value of human resources is the sum of present value of future earnings of both skilled and unskilled workers. We are asked to follow Lev and Schwartz model to compute the value of human resources. According to Lev and Schwartz model, value of a group of human resources is equal to sigma t is equal to age to retirement IT divided by 1 plus r the whole raised to t minus age, where t is equal to retirement age and IT is equal to average annual earnings up to retirement. Hence, in the given question, this formula is first applied to skilled group and then to the unskilled group, and the total of both is termed as the total value of human resources. Applying the formula for a single skilled worker, we get 75,000 divided by 1 plus 0.15 the whole raised to 68 minus 65 plus 75,000 divided by 1 plus 0.15 the whole raised to 67 minus 65 plus 75,000 divided by 1 plus 0.15 the whole raised to 66 minus 65. Hence, the value of single skilled worker amounts to 49,313.7 plus 56,710 plus 65,217, which totals to 1,71,241.88. Applying this to whole 40 skilled workers, we get the total value as 68,49,675.2. We have assumed in the first part of the answer that we discounted the future earnings of skilled workers, which will be received at the end of 65th year. Hence, the annual earnings are received at the end of 65th, 66th, 67th year, and in the beginning of 68th year they resign. In the same way, value of unskilled workers are also found as a present value of future annual earnings of rupees 50,000 received in the end of 63rd and 64th year. That is 50,000 divided by 1.15 raised to 2 plus 50,000 divided by 1.15 raised to 1, which gives the value of a single unskilled worker as 81,285.44. Hence, the total value of unskilled workers are 40,64,272. Adding both the values of skilled and unskilled workers, we get the total value of human resources as 1,913,947.2. Now let us do just one more problem in order to cover 100% of question patterns that could come from this chapter. The following information is supplied to you by AB Limited. Equity shares of rupees 100 each, of which 75 has been called up, 5 lakh. Equity shares in respect of which calls are in arrear at 25 per share is rupees 1 lakh. General reserve rupees 10 lakhs. Profit and loss account balance at the beginning of the year containing loss of 25 lakh. Profit and loss for the year rupees 45 lakh 60,000. Industry average profitability is 12.5% and 8% debentures of rupees 10 each, 8 lakh. AB Limited is proposing to hire the services of Mr. X to turn around the company. Cost of the company in appointing him in that company is given below. Minimum take-home salary per month demanded by Mr. X is rupees 2 lakhs. Average income tax rate on salaries after considering the impact of rupees 3 lakhs per annum, that is exemption amount, is 25%. Provident fund contribution by the employer per month 50,000. Profits over and above target expected by hiring Mr. X 10%. You are required to analyze the proposal and see whether it is worthwhile to employ Mr. X. Also suggest the maximum salary that could be offered to him and also mention the maximum bid price. Couple of notes are provided in relation to the above question. They are A. PF contribution are tax exempt. B. Take home salary is that remaining after employee's contribution to PF at rupees 50,000 per month and after deduction of income tax on salary. In this question, we know that the maximum amount of profit that can be given to Mr. X would be the profit he achieves over and above the current profit. The current profit for the year is given to be rupees 45,60,000 and hence any profit Mr. X enables the company to achieve beyond that could be given to him as his fees. Anything more than that would lead to loss for the company. Now, we will find how much is the profit target the company is expecting to achieve by employing Mr. X to turn around the company. Target profit is given as a percentage of total capital base, which includes all types of equity, preference, debentures and loans. Let us calculate the total capital base. Equity share capital paid up 5 lakh shares of rupees 75 each is rupees 3 crore 75 lakh, less calls in arrears 1 lakh. Next add general reserve 10 lakhs, P&L cumulative loss till last year 25 lakhs, profit for the year 45 lakhs 60,000, 8% debentures 80 lakh. The total capital base is 4 crore 84 lakh 60,000. Target profit will be then 12.5% of the capital base, which turns out to be 60,57,500, and the profit expected to be achieved by employing Mr. X will be 110% of the target profit, which turns out to be 66,63,250. So how much is the maximum profit that can be given to X? It is the difference between the total profit achieved by Mr. X over and above profit achieved by the company in the previous year. This is rupees 21 lakh 3,250. The maximum bid price is found using the formula additional benefit to company due to Mr. X appointment divided by return of investment of the industry. Hence maximum bid price turns out to be 21 lakh 3,250 divided by 12.5%, which is 1 crore 68 lakh 26,000. Now let us find whether the proposal of the company to bring in Mr. X is a viable and profitable for the company. In order to understand that, we just have to know whether total CTC, otherwise cost to the company, in employing Mr. X exceeds the total salary offered to him. If yes, it is not worthwhile to appoint him because that would turn into loss. Therefore, let us now compute the total CTC of employing Mr. X. Minimum take-home salary of Mr. X is said to be the monthly salary after paying tax at the rate of 25%. Therefore, 2 lakh is the salary X gets after paying 25% tax. Hence, this forms 75% of the total salary. However, the cost to the company is the whole 100%. Therefore, we need to find total yearly cost to the company, which is 2 lakh into 12 divided by 0.75, which is 32 lakhs. Company pays their share of provident fund contribution pertaining to the employee Mr. X, which is rupees 50,000 into 12, 6 lakh. The initial take-home salary does not include the employee's share of provident fund. This means employee's share of provident fund is paid in addition to the above salary, which turns out to be rupees 6 lakh. Adding the above three costs to the company, we get the total CTC as rupees 44 lakh. This exceeds the maximum salary the company could afford, which was rupees 21 lakh 3250. Hence the proposal to employ Mr. X is not worthwhile.